it's an all right market still. It is what it is. I like the hybrid market. I think you're going to see a lot more opportunity here, and the reason is that customers are not being talked about. You know, they're hearing the message of the traditional LTC because they're sitting down with an LTC person. That person sells long-term care insurance that pays premium every single year. Guess what? That's how that person gets paid too. Every single year for the life of the policy. Or do you think that the other person wants to sell a one-timer? The customers will want to do what's the best for them. The agents, you know, it's always a conflict, right? The products that are the single pay, these hybrid contracts, have so much opportunity because there's so much money sitting idle. Those are where your dollars should be focused on. If you're talking to your clients about true LTC, not living benefits, but true LTC, these hybrid contracts, because dollars are sitting. Money sitting in CDs, money markets, checking accounts, and they'll take qualified money too. We have a version that will take qualified money. You can roll a portion of your 401k into one of these products to pay for long-term care for the rest of your life. And it's guaranteed and it's paid up.
So these are hybrid?
No, National Guard and Trans and Mutual of Omaha are what they call traditional. And then Lincoln and One America have hybrids. So,
what does that look like? Give us an example.
On the qualified? Yeah, so you're going to have basically a payout every year. You're going to have a 20-pay payout. It's going to, so you take $100,000 out, you're going to take $5,000 a year. That $5,000 a year will be taxable. And the after-tax proceeds will go into a life insurance policy that will be guaranteed, and it'll have $350,000 worth of long-term care benefits. Guaranteed. Okay? So you're going to have a small taxable event every year for 20 years. Because you're getting $5,000 that's coming out as an RMD. It's not an RMD, but it is what it is, right? So you're gonna pay taxes on that distribution. The net proceeds will go into the life insurance. The life insurance is paid up. If you die before your 20 years, life insurance pays out, and the remaining balance still gets paid out to your bennies. If you make the 20 years, you've got a fully paid up, guaranteed LTC plan and life insurance plan. And the LTC is 100% tax-free because it's long-term care.
What is that product called?
Asset Care. It's One America. It's called Asset Care. It's the only company in the industry that will take qualified money. Again, you're paying taxes every year, so you're taking a distribution, but it's a small distribution comparatively.
So they do all the.
It's all internal. You get a 1099 at the end of the year of what you owe in taxes.
Are they doing a 72T if that applies?
It's an annuitization.
Oh.
Yeah,
Oh,
it's
it's
an
like
annuitization.
Own concept, annuity funded life.
Well, the annuity, well, you can definitely do that, but that's not with LTC. It's the same concept, right? I mean, you're just taking your qualified dollars that you can't put into a life insurance policy and putting it into. You're buying a SPIA, same thing. This is buying the LTC though, and you can put it on 2 lives. So think about that. I can take $100,000 of my money, insure me and my wife fully guaranteed for the rest of our lives. If I die and never use a single dollar of long-term care, my wife is fully protected.
So she gets to use the entire amount for
The
her
full
long-term?
benefit, and when she dies, second death, the life insurance, if there's life insurance left, gets paid on to the beneficiaries using qualified money. Again, it's not non-taxable because I'm taking a distribution every year, but I'm using qualified money today. I don't have to take a distribution from my qualified account, pay the tax, and then you spend the money. I'm writing the app today with qualified money, and then they're sending me a 1099 every year for 20 years.
So is there a write-up or a brochure?
Absolutely.
available?
Yeah, I'll make sure I get it to you. Yeah, and I can send you an illustration using $100,000.
That
And
would be
it will
really
be like a second to die?
Yeah, it's a
This is
second to die.
survivorship.
It's a guaranteed second to die whole life plan with LTC. But it's not living benefits, it is an LTC. It's true LTC at home, 2 of 6 ADLs, cognitive impairment. It is true long-term care. So it's all tax-free. So
Okay.
opportunities, right? You have a question?
No, I just want to make a comment because I've used it before. You know, I've had clients get declined for the long-term care, but not the life insurance because the risk was really high.
Yep.
And I was able to use that One America product, the annuity.
Yep.
It's actually pretty good.
Yeah.
I ran the numbers. A lot of people don't know that exists, and I think we may have people who have had lost long-term care sale because they couldn't get it, but through that annuitization.
They have an annuity product, so not the life insurance version. They have 6 different products, so it's a lot of different variants. They have an annuity product that is zero underwriting, that still has LTC benefits, and it will issue it all the way to age 85. No underwriting. You have to wait 1 year to claim benefit. It's not a huge benefit, but anything better than what I have is a benefit, right? So they have solutions, and they claim that they issue policies on 75% of their applicants, which is really high, considering. I mean, who's your client base here? Old and ready to go into a nursing home. That's who your client base is. They issue policies on 75% of them, so that's pretty strong. They're A+ rated. They're the biggest and best in the business. So.
Once again, what was the age limit on that? 85.
So the life insurance is up to 80. I think it's 0 to 80, maybe 40 to 80, but it's not you're not going to underwrite 30-year-olds. It's not your market. The annuity, they have an annuity version that goes all the way to 85.
And the annuity has to be funded by them, see, because I do have this lady, she's 79 years old, and her son is trying to take a policy, but she has no earnings in America as such. She's moved from India to America.
So they're not as big on, so is she a U.S. citizen?
She's not she's got a green card, so she's an Indian, yeah.
It'd be worth talking about. Because, yeah, I mean, we can, I don't know it's a very specific question, so we'll have to talk about that afterwards. So let's talk afterwards, though, definitely. The DI side, there's a huge market here. It's a very, very undersold market. And by far the best market is your white-collar professionals, your doctors, your dentists, your CPAs, your attorney, I mean, anything in that world. Engineers, as long as they're not out in the field 30% of their time or more, if they're in the office, if they're a design engineer but go out less than 30%, they're going to be top rates. Top rates is very, very inexpensive. And when I mean inexpensive, a white-collar policy, the annual cost is between 1% and 3% of your annual income. Very inexpensive. We have marketing pieces that you can market directly to those white-collar jobs.
And it pays renewal forever, doesn't it?
As long as the policy's enforced. As long as the client is still paying premiums. That's,
yeah. It's decent.
Yeah, I mean, they do annualize. What's nice with DI is they annualize the premium for commission purposes. It's still as earned, but it is annualized.
Yeah.
So, I mean, there's opportunity here. Again, white collar, but we can do blue collar. We can do gray collar. You have those options. They're just going to be lower benefits because they're going to be more expensive. So, good? Makes sense?
Yeah.
All right, so the annuity side, we've talked a million times about the different policies that are out here, the different contracts and how competitive they are. Allianz still #1 sold. Athene is introducing a brand new policy. It's already approved in Illinois. We're waiting for WFG to approve it. It is super, super competitive. As soon as WFG hits it, I'll be back here to train you on it because it is a very, very competitive product. It's going to revolutionize this market because you don't have to be securities licensed like you do with Allianz to sell it. Everyone with a life license will be able to sell the product. Very, very competitive. I mean, we saw it again and went, this can't be right. It's really good. Not approved yet, so I don't want to tell you too much. Great carriers, they're all going to have a niche, and the niches are really out there. I'm not going to go through app now. I've talked about it till I'm blue in the face, but know that it's out here, and it is definitely a resource for you. I want to talk more about the opportunities here on this side. This is the slide that I always use, and people are very, very familiar with it. But even in their 401ks, and I'm going to show you that in-service distribution list here, even though the policies you can have all your money in your 401k over here because they probably don't have a lot over here in your 401k, do they? There aren't really good fixed options. I mean, there's bonds, but bonds still have risk. Most people don't look at a 401k and say, I need to be very conservative. Most people go, let's put it in, emerging markets or something like that. Maybe you got a target date fund, whatever. But with risk, with that kind of return comes risk, and customers are looking for safety. That's where they're moving. $14 trillion. The number keeps going up every month. $14 trillion sitting in safety. Why are they sitting in safety? It's because they want to have zero risk. This is what this list looks like, and there's 170, and I'll send it to you, Angela. There's 175 major companies on this list. I just took a screenshot of the very first page, but if you have employees who are who work for any of these major corporations, and I'm going to guess a lot of you do because they're big, big names. These are alphabetical. So you got AAA, you got Allstate right here. You got Alcoa, AIG, ADP. These are huge, huge companies. My company's on there, BB&T. All of these companies allow early in-service distribution. Now, there are rules, and there's going to be rules to each plan, so you need to make sure you're talking to your employee about it, but have them check. Have them call their HR and say, hey, I'm 50. You know, I got a ton of money sitting in there at risk. Can I move some of that? And they're going to say, yeah, probably. You just need a couple forms. Move it over, tax-free transfer, put it into an indexed annuity. The products that are going to make the most sense clearly are going to be specific to that client. But I want to focus on this product, and I know you guys already know this product, but it is such an important product. Yeah, go ahead.
Just quick, do you have any reason to know why a company would want to allow their employees to do non-membership withdrawals early versus some plans that don't allow it?
I think it's just a company feature. I think it's just companies. There may have been lawsuits that have to do with it. You know, I want to be able to take money out. I don't know why a company would choose yes or no. So I don't know that. There's always going to be rules.
Yeah.
I mean, the 401k, when you set up a plan, is always driven by the document. What's the document say? But they do amend those documents. And it was only a few years ago that they really started allowing these. Most companies, you couldn't do in-service distributions. You were younger than 60 or 59 and a half. So, yeah.
Is it usually 50 or 55 to do that? Or 55?
Again, it's going to be company specific.
Mostly on.
You can never do
Where do you
50 is where I see.
You see the most often at 50?
And again, you know, you're going to be talking about customers who are probably 10 to 15 years away from retirement, not 30 years away from retirement, larger chunks of money.
You can never do it for like a 40-year-old, right? I just had to ask.
I don't know that. Again, that's going to be company specific. So you want to just ask. It's not a distribution. I mean, you're not taking constructive receipt. It's a rollover. So it's all about what the rules are. Obviously, make sure that there's a tax planner involved, make sure that they're doing everything right. But there's tons of opportunity there. And I'll send you this list. She went through it, and you said Eli Lilly, and I just typed it up. Did the find stuff. Eli Lilly pulls right up.
Yeah.
So your buddy's a perfect candidate, right?
Yes, that's right.
Yeah. So the Nationwide New Heights, and the reason I want to talk about this one is because it fits so many different scenarios. It's a great accumulator as well as it's a great income product. You know, when we talk about annuities, what is their goal? Every single annuity's goal is income eventually. Whether it be a variable annuity, a fixed annuity, the whole point of an annuity is to take income. That's why the IRS gives it tax deferral. So which product makes the most sense is going to be based upon what the client's needs are, but this product really does a great job, and there's a couple of reasons why. Obviously, all index annuities are principally protected. No risk. And that's a big deal for clients. When they're getting closer to retirement, they want to make sure that they're not going to lose those nest egg. They worked all those years to have this money. 2 years before they retired, 2007, 2008, 2009, people lost 40, 50% of their portfolio, 40, 50% of their 401k. I mean, I've met people in meetings that have said, yep, that was me. Lost 50% and I had to work 10 more years just to get back to where I was before. Because they never reallocated their 401k, they just watched it all the way down. Nobody ever talked to them about it. Index growth opportunity, we've got great upside. The fact that you've got multiple crediting strategies, you know, if I'm looking at a product, I always want to have a product that has more than one option because markets change, right? That's really where the similarities stop, though. What's great about the New Heights is they have a patented way of crediting interest. Theirs is patented. It's the only company out there that does it this way, and in the foreseeable future. Okay? The way that this contract works is it utilizes an index, S&P, EFA, Mosaic, or Zebra Edge. Most people are looking at these dynamic indexes. Everybody can look up, you know, the S&P 500. It's pretty easy when you pick up the newspaper, you know where it is. These dynamic indexes are looking at more than just stocks. They're looking at, and depending on which one you're looking at, the Mosaic 2 is looking at 15 global asset classes. So it's looking at the United States, the UK, Germany, as well as Japan, and they're looking at equities, commodities, and fixed income. What's great there is that when one's up, another one's down. When one's down, another one's up, and it rebalances for the client every year. They don't even need to understand how it works. A lot of clients like to know how it works, but because it's done all internally at JP Morgan, you never have to worry about it. If you were to take your money and wanted someone to build you a diversified portfolio, you'd want something that looks like this, right? I want to have equities, but I don't want to have all exposure. I want to have foreign markets. I want to have all these different things, and I want it to rebalance automatically for me. That's great. A lot of asset under management guys will do that, but their entry point is way more than 25 grand. Normally it's $500,000 or more. Your customer can do it with $25,000. And because it's an index annuity, they got zero risk. What this does is it rebalances every 30 days based upon the last 6 months' momentum. So it's looking at what's doing well, what's not doing well, and it's rebalancing based on that. The best 9 performing is where the allocation goes to. Every month it does that again. It's looking at the last 6 months. So volatility, as volatility increases, it pulls out of those volatile stocks. It doesn't do it overnight, but it does pull out of those volatile areas, whether it be equities or fixed income, commodities, whatever it happens to be. And again, it's global as well. The Zebra Edge did incredibly well last year. I think the average return was over 17%. Large cap U.S. stocks only. Well, the market did very well last year. It was a great stock, large cap stock year. It was a great U.S. market year, but what's it going to do this year? What's it going to do next year?
So it says that, and I just proposed this yesterday to a client, and it has the New York Stock Exchange applies some kind of a control measure there with.
This is an index that's built by the New York Stock Exchange.
Okay.
They're the one, they own it. It's like this one's J.P. Morgan's, this
Yeah.
one's New York Stock Exchange.
So they based on market volatility, they'll put some cash in there. You use U.S. Treasuries, so it's not all stock all the time, right?
No, I believe it's, well, there probably is, you're right. There is cool stocks, U.S. Treasuries, and interest-free cash accounts.
There's no way to determine at any point how percentage of that.
There probably is, yeah, you can probably look on it. I mean, it's on New York Stock Exchange
So it's
website.
out there? Okay.
Yeah, you can Google it. Well, there's a ticker symbol for it. I'm sorry, I don't remember it off the top of my head.
Sure, okay,
But there is a ticker symbol for it, so you can track it.
gotcha.
So you mean to say the global index was available in the JP Morgan Chase, but this is just basically based off the US.
Yeah, so this one is a global. It looks at those 4 countries and those different sectors. This one is looking only at the U.S. large cap stocks.
So you have to decide this at the point of sale as to which place you want to put it?
Depending on what you buy, an 8, 9, or a 10, every 2 or 3 years. And you can put into both. You can put half of the money into one and half of the money into the other, and then you can change your mind every reset period. Which one's going to do well? It's the crystal ball ask, right? I mean, you tell me which one's going to do well. Last year, this one did incredibly well. Last year, this one did what it normally does, around 6%. What you're going to see, though, is that this one does a consistent 6%, around 6% every year. It's a very consistent trend upwards. You know, it's got little bobbles in there. This one is going to have more, it's going to still end about the same, but it's going to do more like this. Because you're not, you know, some years the U.S. stock market's not going to do as well. But when it does well very large, right? When you put the two together and you go back 10 years, so it's a very easy model to say, right? You know, you can pick any time period where it's going to look different, but they end about the same. So the total return is about the same. Again, the Mosaic does more like this, where the Zebra does more like that. Every customer is going to be different, but you can put into multiple and you can go into the other ones as well. Here's what the interest or the par rates and the caps and everything look like here in Illinois. What's nice is they just changed on June 1st that the Mosaic and the Zebra have the same par rate. It's 150% participation minus a 1% spread. That 1% spread is per year. This is the 9-year product. They have an 8, a 9, and a 10-year version. Which one makes more sense for your client is which one you're going to go to. The 9 has the higher participation rates, but remember you got to wait 3 years versus 2 years. So the 8 and the 10 are a 2-year reset. What's great here is remember you can't lose money. Never go backwards. You buy this contract, you put your $100,000 in, and it's going to go up, or it's going to stay the same. Depends on what the market does. What's cool is that they're going to look at that. They're going to look at that value every single day. Remember I said it's the only contract out there that tracks it daily? It looks at it every single day. It's going to apply that 150% participation, and it's going to take out the 1% spread annually. Your customer is going to see what that number is every single day. If they want to log in at the board every morning, they want to log in and see what it did yesterday, they're going to see it. They're going to see it go up, and they're going to see it go down. Just the balanced allocation value, because it's going to peg to the market every single day. I'm sorry, every day it's open. It's going to look at it every single day it's open. It's going to go up, it's going to go down. Your contract value is never going to go down. Whatever your contract value is what it's going to stay at. Market goes down like this value can go down, but it won't go below your 100,000, or in this case, your contract value. In this case, we went up. 3rd year, 119, that's what we got locked in. That number is now locked in for the client. No matter what the market does, it'll never go lower than that. As it goes up, it continues to go up. In the stock market, right, we look at the market over long periods of time, it's always positive. It may have blips where it's not, but over a long period of time, it's going to be positive, most likely. We don't know what it's going to do, but the client will never have risk. What's great here is that balanced allocation value also becomes the death benefit, also becomes the withdrawal value. If the customer wants to take money out, you take a withdrawal. That's just from an accumulation perspective. After 3 years, your 100,000 went up 19% in 3 years. It's pretty strong. Considering it's a fixed product with no risk, over 6% return is pretty darn strong. It also has an income feature. So again, all annuities inherently are going to be that income. Eventually, that's the goal. The income feature on this contract is really, really strong from a market perspective. If I'm looking at guarantees, other products are probably stronger. Meaning, I want the numbers to be guaranteed. I need to know exactly today what that number is going to be in 10 years. I need to know what it is in 15 years. I cannot have any variation. I just need to know what it is. Other products will be better. It does have a guarantee. The guarantee is 1% for 10 years, not super strong. Or the higher of the 1% or that payout factor, and I'll show you how that works, times the highest payout factors in the industry. And when I say in the industry, it's bar none, highest payout factors in the industry. If I'm 60 years old when I buy it, I wait 10 years to turn on the income, I have a 7.37% payout. At 70, most companies are between 5 and 5.5. That's significantly higher. If I wait 5 additional years, so buy it at age 60, turn an income at age 75, it's a 10.85% payout. 10.85%. Again, the industry at 75 is going to be between 5.5 and 6. I'm almost double the payout factor. 10.85 or 7.37 of what is always a question, right? It's just a mathematical calculation. How do I get there? It's going to be of whatever the highest number is. If you buy it with the income feature, remember I said it's going to go up and it's going to go down? The income feature says it only goes up or stays the same. It automatically locks it in for the client every single day. Every single day the market goes up, that's your new low point. Does it automatically for the client. Market goes down the next day, it doesn't change. So all you're ever going to see is an up or a plateau, an up or a plateau. And it's going to do that every day. So markets open about 250 days a year, times as long as you wait. The only downside of the contract is you have to wait 5 years. If you want early income, it's not the product for you. We have tons of other products, the Transamerica product, Athene, whatever else you're looking at. In this situation now, 10 years out, client turns on an income of 7.37 times 189, you're looking at a $13,000 lifetime guaranteed income. The rest of the industry is around $10,000. 13,000, 30% more income every year for the rest of my life. And look at the cash value. You know what these products are, is they're just a payment of your own money and their money, right? And that's how these products work. We've guaranteed you a value, we're going to give you the money, and you're going to spend down your own money. It's just how they work. Most of these contracts will have run out of cash around here, 13, 14 years into the product. After you turn in on the income. This contract still has cash value because it has such a strong growth behind it. What's it going to do? We have no idea. But once you've turned on the income, that number is fully guaranteed for the rest of your life. They do it for joints as well. Make sense?
Yes.
The brand doesn't hurt either.
Nope.
The name on the wall's not a bad one. Make sense? All right, I want to give you 5 minutes. So I just wanted to point out, you do have the ability to run all your own quotes for Nationwide if you didn't know that. Some offices know it, some don't. I just want to make sure you're aware. On the Crump website right here, WFG Sales Material, the New Heights Illustrator Access, you can just click on that. You will have to sign up the first time, but after that, you just click on that link and it'll take you to it. So you can run all your own quotes if you want to. Good. So I want to close out multi-carrier product lines. You guys know the story, that single point of contact. I have contact sheets here if you'd like them. You have specialists in each product lines. You have the ability to use the full website. I would encourage you using it. It's got so much information out there. You have the ability to submit applications electronically. It's about making your time more efficient. The underwriters, if you have those questions, you want to talk to an underwriter, you can call in and talk to the underwriter. As well as we have advanced planning people, the ones with all the initials after their name, the JDs, the CLUs, the CHFCs that can help you with special cases, trusts, whatever it is you need help with. And you know, we don't really talk about DOL. I think everyone's sick and tired of talking about DOL, but understand that DOL is coming back. It probably won't be called DOL. At some point, it's gonna have the fiduciary standard, or the NEIC fiduciary model, or the SEC it's gonna come back. What's nice is that whatever it is, the rules are gonna change and you're gonna be compliant because Crump is gonna be involved. We'll make sure that you're not out of compliance. You cannot submit business if it's not compliant. So, good. I wanna leave you a few extra minutes there, Angelo, so I'm good, I'm done.
All right.
Thank you so much.